Hello guys, welcome back to Coins Tutor, your number one YouTube channel for crypto education and updates globally. It's a boy Siminagachi here with another banger video. And on this video, we're going to be talking about our Model 6 on this free crypto training. And for those of you who just joining this channel, let me brief you a bit. Our channel name was formerly known as Dintech Television, but we changed the name to actually tailor better what we do on this YouTube channel, which is crypto education and updates. And to launch that brand, to launch that beautiful name and give out to the community, we decided to launch a 1 month free crypto course. It's a full packed crypto course, and you're not going to pay a dime. We began the training on 1st of August, October 2024, and it's going to end on 30th October 2024. Don't miss it. This is module 6. The training is divided into two parts actually. The part 1 is of 12 modules, which is all about theories, and every day we do 3 videos. So the theories is going to build you up for what is coming up, all the technicalities that are coming up in the practical session, which is going to be part B on this training. So if you miss a module, watch it. Don't forget to watch serially. If you miss a module, don't watch this one before you watch other modules, because subsequent modules build on previous modules. It's going to be difficult for you to understand whatever you're watching if you've not watched the subsequent modules. Okay, so this is module 6 already. If you not watched the other one, go back in the description. I'm gonna drop the link to previous videos in the description below. The WhatsApp community link is also going to be there just in case you want to join our WhatsApp community. But before we delve deep into what we have on this module 6, I'd like to implore you to please subscribe to my YouTube channel. Give me thumbs up, share the YouTube link with your family and friends. That's the least you could do for us. All right, I love you guys. Let's get there. If the course outline we have here on our list is what you really want to learn as a beginner, then stick around with me. I'm going to simplify this. It's my job. I'm a very good teacher, and my job is to simplify what sounds so difficult. All right. If you've been watching my videos, you already know that's my gift. That's my calling. Okay, so on module 6, we're going to be looking at stop loss and take profit. We're going to look at market and limits and stop orders. Then we're going to look at what is a pair. And lastly, we're going to look at spot trading on SEX versus swapping on decentralized exchanges. So the first thing is stop loss. Now, previously we talked about on module 5, we talked about how to buy trading on spot and then trading on futures. And on futures, I told you about how your impermanent loss could get to a specific level, and then all of a sudden, ooh, your capital is gone. Like you get liquidated and your money could just die away, right? And you'll be wondering, is there no way to stop something like that? Is there no mechanism to stop it? The good news is we have something like that. And that's the only power you have in the market. The only power you have in the market is to control how much you are willing to lose if trade goes against you. So, and that mechanism is called stop loss. So a stop loss is a preset order to sell an asset when its price reaches a specific level, like the losing trades get to a specific level, and that is where you want to leave the market. So limiting potential losses. Stop loss is like a safety net which safeguards you from being liquidated or losing all of your capital or asset if trades go wrong, right? You bought Bitcoin at $30,000 and you're aiming for 60,000. Futures is all about forecasting, right? You're going into contract. You're not holding any real asset. So peradventure, you should also think life is not linear, for God's sake. You should also think of what if Bitcoin goes to 20,000 and you bought at 30,000. That means you're going to be losing a whooping $10,000. But there should be something to stop you from going down that much in loss, and that is stop loss. So you could decide to tell the market, hey market, if Bitcoin ever goes down to 20, for instance, $29,000, I'd like to leave the market. I'm okay losing $1,000. I wouldn't want to lose more than that. So to do that, you set what we call stop loss, and stop loss is going to keep you safe. If in futures, we do both buy and sell. You trade both ways. If Bitcoin is at $60,000 and you're selling it, remember when you're selling, it means you're betting that it's going down from 60,000, right? And then eventually you should also think that what if eventually Bitcoin gets to 65,000? That means you're going to be losing money, right? So you should tell the market, hey market, if I'm selling Bitcoin at 60,000, I would like to leave at 62,000. If Bitcoin rises above where I bought, if it gets to 62,000, take me off the market. I'll be fine with what I've lost so far. So that's stop loss. So in setting stop loss in futures, you set your stop loss below your entry price in a buy, and then when you're selling, you set your stop loss above your entry price in a sell. So let's look at take profit. Now you've taken a trade, and of course you're expecting that profit is going to come. But what if profit market volatility is crazy? You could see a trade that gives you $1,000, and you expecting that it's going to give you $10,000 more, like most of you would think. And all of a sudden you come back and you see $100. 1,000 becomes $100. And next time you don't want that to happen. You want to set a mechanism that, hey, you want to define exactly what you want. This profit is going to be enough for me. What is going to take you out when price gets to that your target profit? That is what we call take profit. So if you buy Bitcoin at 30,000 and you want to leave the market at $40,000, that's making $10,000 profit. You are going to you're going to buy at 30,000, then set your take profit at the 40,000 price. That means if market gets to 40,000, right, you're going to be taking out in profit and you make $10,000 profit. If you're selling on futures and you sell Bitcoin at 60,000, you're expecting that it's going to fall to like 40,000. And when it gets there, be okay with the profit. Then you set your take profit at 40,000. So in a sell in futures, your take profit should be below your entry point, right? In a buy in futures and in sports, your take profit should be above your entry price. Okay, so that's take profit and stop loss. So the next thing we want to do is to look at Ethereum chart showing stop loss and take profit areas on spot trading. We also look at how it looks like on futures trading. So on spots, if you buy here around this area, this is the green. This green area is the entry point for a buy 1,824.5. This is Ethereum chart. If you buy there, then you're expected to set your stop loss either higher than this price or below this price. But I decided to set my stop loss. This is a stop loss around 1,595. So in a buy, your stop loss is going to be below your entry point. As you can see, this is 1,824 and our stop loss is 1,595, which is below our entry in a buy. So your take profit in a buy should be above your entry price. This is of course our entry price, 2,380. Sorry, I forgot to mark a horizontal line here. It's not like I forgot. I didn't want this chart to look so technical. I didn't want, I understand I'm dealing with newbies. Drawing too many lines is going to make it look unnecessarily big. So in a buy, your take profit is going to be above your entry point. So this is where we bought, and this is where we took profit. So when you're trading on spot, if you're taking profit, it means your trade has already made profit. It has grown above your entry. So you could either say you're taking profit or you're selling. So when you bought it, you could take profit here. You could also take profit here. Remember on spot, when you buy and you are leaving the market or the trade in loss, like you bought here and market came below where you bought and you still want to close it, that one is not more called take profit, it's called selling. So selling is selling for whether you're losing or you're gaining on spot. But the moment you're leaving because you gained, it is called take profit. You're taking profit, but you could also say sell. Okay, so let's look at Ethereum chart showing stop loss and take profit areas on futures trading. Okay, so one more thing, in what is it called? In just our keynote, on spot, you buy low and then set your take profit above entry price. Then set stop loss below entry price. Okay, I said that already. I thought I omitted it. So this is an Ethereum chart showing stop loss and take profit areas on futures trading. Okay. So in futures trading, remember we can trade both ways and you're not buying any real assets. You're just betting on price movement of any asset, and that is called a contract. So the contract, to sign it with the decentralized or centralized exchange you're trading with, if it goes for you, you make profit. If it goes against you, you make loss. If it goes so much against you, you get liquidated. So on futures, let's talk about a buy. In a buy, you can talk about long position. Okay. So in a buy, you expect to buy low and take profit above. So we bought here, right? And then our stop loss is below our entry, just as it is on spot. Then our take profit is above our take profit, above our entry. So since we bought here and set stop loss here, if Ethereum price ever dumps to 1,595, it's gonna take us out in loss, and we're gonna lose a little. So we won't be able, we won't lose all our capital, won't get liquidated, guys. This is the only power you have in the market. Don't jeopardize it for anything. Don't let any strategy confuse you, tell you the strategy is good, you trade without stop loss. That there's always a fake out that takes stop out. You stop you out and then continue in the direction you eventually forecasted or predicted. So because of that, I developed a strategy that does not involve stop loss. It works. It works like magic. Yeah, it might work like magic. Okay, it might work like magic, but the day to fail is gonna be disastrous. I'll tell you a story. Let me complete what I'm saying. So in a sell under futures, right? You sell above, set your take profit below, and set your stop loss above. So you sold, what is it called, Ethereum at 4,711. Your stop loss is above it, which is 4,976. So you're telling the market, if you ever get here, take me out in loss, the little loss I've taken, I'll be fine with that. I don't want to lose more than that. I don't want to lose less than that. And profit, if it ever gets to this level, you're telling the market, take me out. I'm okay with the profit. I don't want more than that. I don't want less than that. When we get to advanced level, we are going to expand taking profit and stop loss, where we talk about trailing stop, break even, stop profit, and all that. So our brief note here: in a buy, set TP above enterprise and stop loss below enterprise. Then in a sell, set stop loss above enterprise and take profit below enterprise. Now, my story. I know you've been waiting to hear that story. I was working for a company. I'm not going to say the name for privacy reasons. I was working for a company some time ago in Port Harcourt as a trader. In fact, I rose to a position where I became the trading studio manager, right? Now, we were doing fine until we got a strategy from some set of Canadian traders. I mean, a well paid strategy, well paid information. The pattern of trading is scalping. When we get to kinds of trading traders, we'll talk about it. It's scalping. So what it do basically is scalping, and it's high tension scalping. We scalp in seconds, and we don't use stop loss. And our head, the owner of the company, of course, he wanted the best for all of his investors and his traders. In fact, he wanted to get all his traders a car. Like, he didn't want us to just be his traders for nothing. He wanted to get us brand new cars, all of us, especially studio managers like me, very good cars. And he wanted to increase payout for his investors. He wanted the best for the company. And so that strategy came. We started using it because we wanted more returns. We were killing it. There was a day we made almost 500%, and everything was moving on fine. Every day we were killing it. Every day we were killing it. You know, in trading studio, I don't know if any of you have worked there. In trading studio, when trades are bad, you could sleep in studio throughout the night to monitor the trade, right? But in this one, we were killing before 11 a.m. West African time. We're already done with trading because the strategy was working like magic. but the bad day came. The bad day finally came. The eventual bad day. It came finally. The day it came, we were stuck on trade because the strategy involved trade scalping without stop loss. So that day, and we had over 17 states. There's a way we trade. We call trades online. All the studios across the 17 states will be on the same Zoom, right, meeting. So as we call trades, as we call buy, everybody across the 17 states, almost 500 traders, we are taking the same trade. So as we are losing serially. So that day we were caught on trade. The whole 17 states, we were caught on trade. So we lost almost a 1 billion naira, and it's just within a week because that lost 8 deep and 8 deep and continued. We cut the loss. We now started trade. We started fighting the market. The trading became so disastrous. So we kept losing and losing until eventually across the 36, 17 states, we lost more than 2 billion naira investors' money. And that was how the company crashed. Now, people who were not, who don't understand that story, some person said the CEO, the MD embezzled funds. He did this. He played games, blah blah, and all that. That was not the case. It is just we who worked in the studio that know what actually happened. We lost all the money, and that man, thank God, he did not die. That man is a strong man. I admire his courage. The way he was going, if he wasn't a strong, the way things were going, if he wasn't a strong man, he would have died. This is why did I tell you this story? This is what trading without stop loss can cause. Guys, don't give up on the only power you have over the market. So that is stop loss for you. Let's get to the next thing on our slide. So on our slide, we're going to talk about market limit orders, right? So on market limit and stop orders, I've talked about buying, I've talked about selling. Now there's one thing you should have been asking yourself. You want to buy low, right? And sell high to make profit. And probably you get to a point where you know that there's a point where the price of assets could actually get lower than what you're seeing currently. Probably you're seeing Ethereum at 3,000 for a coin, and by way of knowledge or experience, you're saying macroeconomic data, major news releases is fueled in the market, and eventually when I sleep, when I'm asleep, just while I'm asleep, Ethereum might fall to as low as $2,000 and then spring up back to 3,000. What do I do so I don't miss that kind of opportunity? You're going to set a mechanism. You're going to give the market an order telling the market to buy for you when Ethereum gets to 2000. That kind of order is called buy limit. But the order where you're buying in the market at that 3000 you saw Ethereum, you just want to buy now, is called market order. Some authors call it instant execution, but market order is widely used. So you just enter, you buy pair, you're in the trade, you're holding the asset. That's market order. But the one you want to buy, you have a price at heart. You're expecting, you think that the price of that asset might get there, but you won't be available to buy it. So you're telling the market, if price gets here, buy for me. Whether I'm there or not, whether you're asleep, whether your phone is off, whether your battery is off, whether internet is off or on, it doesn't matter. The moment you set that price, buy Ethereum for me at 2000, you are actually going to be in that trade. So a buy limit is a kind of order where you're giving the market an order to buy for you at a cheaper price below the current market price. So for instance, current market price is $3,000 and you're telling market buy for me in future when price of Ethereum gets to $2,000. So that's what a buy limit means. Now sell limit, you bought you know you want to sell high, right, for profit on spots, or you want to sell high higher in futures to get a better entry price. So sell limit is a kind of preset order to sell an asset when its price reaches or exceeds a specific level, securing profits at a favorable or higher price point. When selling when setting a sell limit order, your sell exit price should be above current market price. So if you're selling Ethereum, for instance, at $5,000, sorry, if Ethereum market is currently at $5,000, right, your sell limit should be above $5,000. So you're telling the market, if you ever get to 5,500, 5,200, or $6,000, sell for me. Okay, so you set a limit there, and when the market gets there, it is actually going to sell for you. So that's what a sell limit is. Sorry guys, let me see what. So a buy stop is what we're going to talk about now. A buy stop is an order to buy an asset at a specific price above the current market level, anticipating upward movement. In a buy stop order, your entry or buy price should be above current market price. When setting a buy stop order, your trigger price should be lower than your entry price. Now we're going to look at that when we do practicals. We're going to be setting these things practically on an exchange. For now, for theory's sake, for basic reasons, just know that in a buy stop, your price should be above current market price. Now, the psychology behind it is market is actually dumping low, it's dumping low, but you have a particular place for when you probably when you become a technical analyst on the chart, or probably a zone where you think if price actually gets to this point, it will be difficult to break below it and go back. So if it gets here, technically it's going to keep going up from there. So that kind of area is going to be your entry for a buy stop. So probably Ethereum price is at 2,000 or $1,000, and you're looking that if it comes to $2,500, it's going to keep rising from there. So you're going to set the entry of your buy stop at $2,500. That's what pretty much a buy stop means. So let's look at a sell stop. In a sell stop, we see it as a preset order to sell an asset when its price falls to or below a specific level, preventing further losses. In a sell stop, your exit price should be below current market price. When setting a sell stop order, your trigger price should blah blah. That's when we're doing exchange practical. So in the sell stop, see the psychology behind it. Market is actually going up and up and up, and you actually by way of knowledge know that there's a point where it will fall to, and it will keep falling from there, right? At that point is going to be your entry price for your sell stop order. So let's say Bitcoin is at $70,000, and you're by way of focus and knowledge thinking that when it gets to $65,000, it will keep falling from there. That $65,000 is going to be your entry price for um your sell stop. But before I continue, I'd like to reiterate that your your buy stop, right, you could actually set it as, all right, let me let me not make this big. When we get to practicals, I'm going to expand that. All right, so the next thing on our list is, what is a pair? This one is a very beautiful topic, and I know you've been waiting for it. So in crypto trading, a pair represents two currencies being traded against each other, such as BTC USDT, Ethereum USDC, Ton USDT, Not USDT, Omikami USDT. I know most of you don't know this one. This one is a very huge sleeping giant. It's a meme coin with utility anyway, so etc. You buy the base currency. This let's pay attention to this note. You buy the base currency with the quote currency and sell the base currency for the quote currency. I know why I decided to write it this way. I didn't use the usual way of defining pair. There's a usual way of defining it. Most authors define it in that same way. I wanted to be different to make it, to simplify it. Like this is more like a practical definition of pair, what it really is. Okay, so to buy the base, you must have the quote. If you want to buy ton on Bybit, can you buy ton without first, if you want to buy ton on Bybit or Binance, let's talk about a pair first. It's pertinent to understand that you cannot buy that coin alone. You cannot go to Bybit and see just ton standing alone. You can just buy ton. You must see ton paired with something. If you want to buy BTC on Binance, you cannot go to Binance and see Binance Bitcoin standing alone on a currency list. It has to be paired with something. And since it has to be paired with something, that means something is required to buy the base. So for instance, you go to Binance and you see ton USDT and you what you want to buy is ton. You cannot buy ton if you already don't have USDT. That's what I'm trying to say here. And then if you want to sell ton, you just want to say, oh, I want to sell ton for USDT. You cannot sell ton for USDT when you don't have ton on your portfolio. For you to sell ton, it means you had already bought ton or somebody actually sent ton to you. So you have ton, so you can sell ton for USDT. For you to buy ton, it means you already have USDT you want to use and buy. So that brings us to an explanation of what a pair is. So before I get into that, there are three categories of pair. We have the crypto to stable pair, where you pair a volatile coins against a stable coins. And we have example of that here: BTC versus USDC. USDC is a kind of volatile stable coin, just like USDT. Another example is ton versus USDT. So this first set of pair are under the category crypto to stable coin kind of pair. So the second kind of category when we're talking about pair, the crypto to crypto, which means pairing a volatile coin against another volatile coin. We have example here: Ethereum versus Bitcoin, um, Binance Coin versus Bitcoin. And then the third category here is the crypto against fiat currency, like our normal traditional fiat currency. So here we have the Bitcoin versus US dollars. And then here we have XRP, which is Ripple versus Euro. These are the categories of pairs, the three categories of pairs we have, and they are represented here. Now, let me expand more on the base and the quotes. When you look at a pair, the currency to the left part of it is referred to as the base currency. The currency to the right hand side of the pair is referred to as the quote currency. If you don't call it currency, some authors call it counter currency, COUNTER, counter currency. So, but quote is more often than not used by majority of writers. So this is the base, this is the quote. So the base is to the left hand side, the quote is to the right hand side. So to understand what a pair is, generally, simply put, if you get a pair on any kind of exchange or decentralized exchange, whenever you're buying a pair, that pair, pay attention, whenever you're buying that pair, it means you are using the quotes to buy the base. In other words, you cannot be talking about buying this pair if you don't have USDC already. So to buy BTC USDC pair, it means you already have USDC to buy BTC. You cannot pick BTC USDC pair and want to place a buy on it when you don't have USDC. Even if you have USDT, you won't be able to trade this pair because you don't have USDC to buy it. So you must have USDC to trade this pair. If you want to buy this pair, it means you're using USDC to buy Bitcoin. And then if you want to sell this pair, it means you are selling BTC to get USDC. I hope that's clear. So coming to this side, still on coins to stables, stable coins pair. If you're buying ton versus USDT pair, it means you already have USDT, right? And then you're buying ton. If you're selling this pair, it means you already have ton and you're selling it for USDT. So that's pretty much what a pair means. Let's get to crypto pair category, which is a volatile coins paired against volatile coins. If you want to buy Ethereum Bitcoin pair, it means you already have Bitcoins you want to use to buy Ethereum. And if you want to trade Ethereum for Bitcoin, like you want to sell Ethereum to get Bitcoin, means you already have Ethereum in your portfolio. Remember, it doesn't matter how you got that into your portfolio. What matters is that you have it in your portfolio. So if you want to trade the BNB BTC pair, if you want to buy BNB BTC pair, it means you already have Bitcoin you want to use and buy BNB. So if you want to sell BNB BTC pair, it means you already have BNB you want to sell for BTC. Now, when we get to the coin versus fiat currency pair, is still the same rule. If you want to buy BTC US dollars pair, it means you already have US dollars you want to use to buy Bitcoin. And if you want to sell Bitcoin versus US dollar pair, it means you already have Bitcoin in your portfolio you are selling to get US dollars. And on this side, if you want to buy XRP, Ripple versus Euro. If you want to buy this pair, it means you have Euro in your portfolio. You are using to buy Ethereum, Ripple. And if you want to sell this pair, it means you have Ripple. You are selling to get Euro. I hope this is very clear. Um, in our next video, in the practical sessions, when we start to trade practically, you're going to see how these things play out. I'm going to put USDT on across different exchanges: Gate.io, Binance, Bybit, which other one? Bybit, Gate.io, Binance, Bybit. There's one other exchange we'll also touch. We might look at Mexshare. So we are going to look at practically how these things work. But just understand one more thing before we leave. If you trade a pair, for instance, BTC, USDC, you already had USDC, you used to buy BTC. The moment you buy a pair, the base which you bought is now what you're going to hold. That's if we're talking about spot now, right? Is what you are going to hold. You are holding it. It's going to remain in your portfolio until you sell. One more time, if on spot you buy a pair, which means you used the quote to buy the base. The base is what you're going to have in your portfolio, which is in this case BTC. If you bought BTC USDC pair, that means you use USDC to buy BTC. BTC is now going to be in your portfolio or on your portfolio until you decide to sell this same pair. So to sell BTC, you're still going to choose this same pair and then you sell BTC for USDC. But one more thing. You could also decide to sell this BTC you're already holding for another kind of currency. I almost forgot to highlight that, right? You picked a pair, right? You bought that pair, meaning you used the code to buy the base. The base asset, you're already holding it. You could sell that base asset for another kind of currency. It doesn't necessarily mean you must sell it for the USDC you used to buy BTC. So in this case, we bought BTC USDC pair. That means we bought BTC with USDC and we're holding BTC. We want to sell BTC in future. We could decide to want to sell BTC for USDT in future. We could decide to go for BTC USDT pair, right? We could also decide um to go for BTC if we want to sell it to what is it for BNB, right? We could decide to go for BNB BTC pair and then sell. So when you sell BTC, you are going to get BNB. So that's how pair works in trading. I hope this video is explanatory enough. This pair trading and all that. Now the next thing we're going to look at on our slide before we wrap it up for this module is spot trading on centralized exchanges versus swapping on DEX. So when you're dealing with centralized exchanges, as far as it relates to spot trading, we are saying there are key things you need to understand. So on spot trade and on centralized exchanges vis-a-vis spot trading, you are going to be buying a pair. Like is a pair you are buying basically. So it means you are buying the base with the quote currency. After purchasing the base, the assets, I think I highlighted this already in the previous slide. So after purchasing the base, the asset remains in your portfolio until you sell them for quotes. Like the quote is the currency you use to buy it. In the case of BTC USDT, USDC, So to buy the base, you must have the quotes already in your custodial wallet. No, this is wrong. There's a typographic error. I was supposed to write the quote, not the base. To buy the base, you must have the quotes. Sorry, not base. You must have the quotes already in your custodial wallet. Custodial wallet is a wallet that is in your exchange. Remember, Bybit, Binance, Bit.io, KuCoin, and all that. So, and then vice versa. To sell your base, it means you already have bought with the quote. So you know what I said earlier. So when you sell or short a pair, you are invariably selling the base currency for the quote currency, right? We explained all of that. So swapping on decentralized exchanges is not the same as trading on centralized exchanges. When you're swapping on decentralized exchanges, you have to trade with a non-custodial wallet. So you access decentralized exchanges via a non-custodial wallet. So you can connecting them. You can connect it by visiting the website of the decentralized exchange on a separate browser, or inside the browser, inside on the non-custodial wallet like MetaMask, Trust Wallet, Token, Tonekeeper, Soulflare, Phantom, and all that. Inside there, there's something called D app. You could click on the D app and visit any website. So when you go inside there, you could visit the website of the decentralized exchange and then connect it, or connect with browser. But I recommend visiting in the D app of that decentralized wallet, the non-custodial wallet you're using like MetaMask, Trust Wallet, and all that. So you visit the decentralized wallet, connect your wallet. In the blockchain you're trading inside that decentralized wallet, you must have the native token of that blockchain. Now, you cannot trade on any decentralized wallet if you don't have the native token of the blockchain you're going to buy the coins in on that decentralized wallet. So that's why I said to successfully complete swaps on any DEX, you must have some gas fees. Gas fees is what we call it, is a fee you pay for running transactions on any decentralized exchange, especially through non-custodial wallets. Let me tailor it to that aspect. So this means you must have some unit of the native token of the blockchain in which you are swapping a token or coin for another. So note that when you're trading on any blockchain, as long as you're trading on a decentralized wallet, you can swap any token at all on that same blockchain for another token. It doesn't mean it must be the native token of that blockchain that you're using to buy token. For instance, you want to buy um, Omikami, which is built on Ethereum network. It doesn't mean you must use Ethereum to buy Omikami. You can swap any other coin that is built on Ethereum for Omikami, but then you must have some unit of Ethereum to cover for gas fee before you'll be able to run your transactions on Ethereum blockchain through uniswap.org, which is the number one decentralized exchange for all projects built on the Ethereum blockchain. I hope this module 6 was interesting. I hope you got value for watching. I hope you didn't just sit for nothing. Before I leave this tutorial, I'd like you to subscribe to my YouTube channel like always. That's the least you could do for me. Give me thumbs up, share the YouTube link with your friends and family, and I'll be with you in the next module, which is module 7. It's going to be explosive. Don't forget, watch the videos serially. If you've not watched previous videos, the link of previous videos are going to be in the description below, and the link to our WhatsApp channel is also going to be in the description below. This is Simeon Agachi, your humble, your amiable teacher, saying goodbye. I love you guys. Do have a very wonderful day. Bye.